Hello, I'm Brad Pappas, founder of Rocky Mountain Humane Investing, a fee-only investment advisor with clients throughout the United States. I'd like to address an issue that's paramount to individual investors today: how to cope and plan around a bear market. A bear market in which the major indices can fall by at least 20%, if not more. Being an independent firm with client assets at Charles Schwab, we are very proactive in protecting our client assets from extreme declines. Extreme declines can be devastating to your retirement plans and your future standard of living. And how an investor handles themselves during these periods represents the single biggest challenge to your long-term success. If you're an investor with one of the large mutual fund complexes and you call for advice during periods like now, you'll be told by one of their reps that market timing is impossible and that you're invested for the long term. Boilerplate, or something along those lines. That statement is biased and largely untrue. We will say that market timing in the short term is impossible. Longer term, it's much easier. Big firms managing many billions of dollars are limited in their ability to raise cash and be defensive on your behalf. They're too big, they don't adjust for high-risk markets. For better or worse, it's the responsibility of the investor to protect themselves. Retail investors have a tendency to have recency bias. This means that if in recent years their investments have done well, they think it's very likely that this will continue. This is based on hope, but it isn't reality. During this time, I'm always thinking about how do I protect my clients for when the next bull market ends and the bear begins. Here's a real-life example. Let's assume you're a 55-year-old investor. You're about to experience a 30% decline in the stock market, and let's assume you're starting with $500,000 at risk. Most bear markets are not quick events. They can take upwards of a year or more to evolve. This means not just lost money, but lost time as well. Now let's assume the bear has ended, you're now 56 years old, and your principal fell from $500,000 to $350,000. Now, just to get back to even, you're going to need a 41% return on that $350,000 to make it back to $500,000. For a 41% return to break even, you'll need at least 2 consecutive positive return years of 19.5% on average to return you to your high water mark. Now, after the 1-year bear market, 2 more years of positive returns, you're now 58 years old, as 3 years have passed, and you've made no return on your investment. This is the predicament many investors face, leading to retirement. So here are my thoughts on what we can do for you. We would have a plan in place that may only be enacted once every few years. We are not short-term traders. If there was an effective plan in place to have your assets protected should a bear market occur, you'll have the following benefits. Much less anxiety, you can ignore the media, and absent the need to constantly check your balances. Less risk during the bear market, since your cash should be invested mostly in treasuries during the bear. And for RMHI clients, the silver lining is that you and your accounts will be ready for when the new bull market appears. It's my experience that clients would be excited rather than racked with trepidation. Now, my compliance department would like me to add the following. There are never any guarantees in investing. We do our best to protect our client assets, but it can never be considered a guarantee. Our systems are not designed to get you out at the absolute top, nor at the absolute bottom. If you're ready to schedule a meeting, you can call me at 970-222-2592 or send an email to brad@greeninvestment.com. Thank you.